All right, good afternoon, everybody. How's it hanging? I'm an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure is roughly the same as last time. I think I had circle short still then. I got out of that on Friday, and coin I had short, which I also got out on Friday. Had a couple bucks. Markets continuing to come down here a little bit after hours from the close. That close surprised me, I'll be honest. I thought we were going to sell into the close on the rebalance. It did not happen at all. We're selling after the close. We went higher on the rebalance. There was an MOC to buy into the close, and we ripped into the close. It was really kind of wild. So we are off. I don't know, 50, 60 cents from where we closed. And even with that, SPYs are up 0.4%. Qs are up 0.5%, also off their close. And the IWM is flat. It's down 20 cents. So it closed positive, but now it's trading flat. So interesting. Yes, super, super strong close today. Today was day 5, day 6 to the upside, depending on how you want to look at it. This market's just been incredible. I really thought we might see a little bit of heaviness on Friday of last week through today's trading session, just off it being end of month, end of quarter, and the big pension sell. And it just did not happen. It did not happen at all. The close was so strong. But it's like I said to Greta, maybe it's just everybody knew that this was coming and it was overwhelmed by other flows. If you're, it's all just pieces of the puzzle, right? If there's a sell imbalance, it's going to be $28 billion, or sorry, a pension rebalance is going to be $28 billion. That's just one flow. There's all the other flows out there that have the potential to overwhelm it, and it seems that that's what happened. So day 5 to the upside, market is so strong. Day 5 is the breakout, really day 6 to the upside. We are not extending up with momentum that's getting us to extreme extension. Really, I mean, I guess we were starting to get there at highs today. Yeah, at highs today to the close, we did hit extreme extension into this with the spies, but it's been kind of a grind getting there. Most likely, short-term tactical will be in the red again tomorrow, so that'll be a day 3 to the red. That actually, there's 2 other days right before that where it closed barely outside of the red. We almost could have been at 5 days in a row of short-term tactical in the red zone. I don't think I've ever seen before. This has been a market of firsts in 2025. In April, I saw things I'd never seen before. I saw a degree of downside extension I had never seen before. I had seen short-term tactical in the green for an amount of days. I think it was like 6 days in a row or something like that I had never seen before. And we're seeing that on the upside now to some degree as well. Market's at all-time highs. It's continuing to squeeze. The craziest part about it, I'm not sure if everyone was watching when I was talking to Greta earlier today. I read this Deutsche Bank research note over the weekend that it kind of I like when I read a research note that just very succinctly describes what I already know, and it basically was just like, so all our data shows that the funds are really underpositioned. So you might ask yourself, how is it possible for this market, right? All of the fund selling that occurred brought us down from SPY 613 to SPY 480, let's call it. But now we're at a new high, yet the amount of buying that has occurred when you look at like hedge funds specifically, long only funds, long short funds, and even the systematic funds is not nearly as long with the same amount of length as it was back in February. How is that possible? And it pointed to one main thing, though there's definitely a second one. The one main thing is corporate buybacks. And a lot of the beginning portion of this move higher was on very low liquidity. So if you've got corporate buybacks or any buyer that's coming in a low liquidity environment versus if you like selling down in a higher liquidity environment, the more liquidity that there is, the less buying or selling it takes to move the market. So it is possible for what has just occurred to occur, which is that the market could go all the way back up to a new all-time high, yet there's a lot more ammo to the long side here at this price than there was in February. In February, we called that high so perfectly as a team because we knew that there was no one left to buy. We were able to look at pretty much every cohort of investor, market participant, except maybe to some degree retail, but retail was buying like crazy at that point also. And we were able to say, look, there's not only is there no one left to buy, but if we can get a down move because everybody's already in the pool, it can really feed on itself. Now we're in a situation where we are at a new all-time high, but aggregate positioning is very like medium. It's very medium level. We are not in a spot right now where the risk is to the downside. And if anything, when you add on the vol control bid that's about to come in on this market, the risk is to the upside from a positioning perspective. Systematics are going to continue to buy, and markets just work in feedback cycles. So that underlying bid, especially if the market stays quiet over the course of next month, will just facilitate a grind higher. And I think within the confines of that grind higher, those funds, which I think in Pat's note this morning, we had an update from the that Goldman Sachs positioning. Yeah, look at this Goldman Sachs positioning sentiment indicator thing. All this is done now is get exactly to the zero line. We had been under positioned for weeks at a time here from a fund perspective. Now the market's at all-time highs. There has been buying. You can see that the light position has gone to zero, but we're not even close to stretched positioning at this point. So there is still a lot of room to the upside, and in fact, we know that there's still going to be a lot of forced buying that comes in over the course of the next 1 month. With that said, I don't believe in chasing price, and even within the confines of a strong underlying never-ending bid to this market that's going to happen, should continue to happen, I don't chase price. And at certain degrees of extension, you can be calculated in looking for shorts. And I think that when we are at, $10 of extension or more, and combined with short-term tactical being red for multiple days in a row, the S&P trading above that upper Bollinger Band, and just doing our day count and seeing that we're at a day 5, a day 6, a day 7, that we are at a spot here where you can be looking for tactical shorts that can last as day trades. Maybe it can last 2 or 3 days. But that's it. And if anything, if those shorts work, they're setups for probably the better trade, which is the long trade, the with trend trade. Trends can last for much longer than people expect. And this has been a perfect example of something that I've already known for me. I remember, back here on April 21st, when the SPY was at 510, I was really bullish. Thought we could get a move up to 570. It's a big move. I was very right. But now look where we are, approaching 620. Trends last for much longer than people expect. They feed on each other. Markets work in feedback cycles. Buying leads to more buying, right? This has just been a feedback cycle that has now lasted for 2.5 months of different cohorts of investors, systematic buyers, discretionary funds, just exchanging the baton of who needs to buy because of various events that are occurring. CTAs need to start buying, volatility starts to go down, vol control begins to buy, hedge funds get forced in, retail continues to buy. It's just one after the next, and it seems like we are on the cusp of the next leg of that. And based on some other research I read, there's a good chance that the positioning risk won't become to the downside like it was in February again until maybe mid-August. So this is just a bull market. That's what it is. The news doesn't matter. The fundamentals don't matter. Nothing matters. Market structure matters. And market structure still points to higher. Technicals matter. And the technicals say, hey, we're extended here. You can look for some cute shorts. But that cute short, if it works, just sets you up for what's probably the better trade, which is that next bull flag breakout, that next pivot low continuation trade. And that's what we want to be looking for. So, again, where we are here today, if we were to gap up tomorrow, I still will like the idea of pushing the shorter term shorts because it'd be a day 7 gap up with a ton of extension. But when we get the setup and that ADMA catches up to price or price catches up to the ADMA, that's when we want to be looking for the next long setup for continuation. And that's pretty much where it's at. I really thought we were going to roll down into the close on that pension rebalance today, and I could not have been more wrong. That last hour and a half of the day, partially brought on by this Apple move, was just incredibly strong, incredibly strong. So pretty much all I got. Pretty big picture thought process in there today. We're just gonna take it one at a time, one day at a time, and I'm happy to answer any questions that you guys might have. Captain Condor. I think from Dave S. Should we either as a team or individually try and focus on finding those with trend trades instead of trying to scalp shorts in the index based on what you just said about shorts that work being long entries, risk managed, but not really ever getting anything out of the last trailing piece of these days? I think that's so you're not getting anything out of the last trailing piece. That's expected, right? Counter trend trades are inherently have a lower reward profile. So when you're creating a game plan for your counter trend trades, you want to keep that in mind. You don't want to be super greedy on a counter trend trade. You want to be booking profit quickly on it. You want to be trailing it tight. You want to be keeping it tight, booking the profit and getting out of the way. So I still like going the other way on the market in periods where we get more extreme, and we are in one of those more extreme periods now. Because again, we just had 6 positive days in a row, and we finally were able to tick this market into $10 plus extension off the ADMA on the daily. So I like looking for those shorter term shorts. And again, short term tacticals could probably be in the red again tomorrow. You can make some money for yourself by being strategic and being a real surgeon on those opportunities. But the bigger, better money is always with trend. So it's up to you on how aggressive you want to be here on day 6 to the upside. I'm not an advocate of new longs. I'm never going to be an advocate of chasing price unless it's, the market's extended, but you're trading Oracle and Oracle's trading on news. It's a little bit of a different story. But otherwise, I like the idea of looking for those cuter, shorter tactical shorts. You just got to recognize what kind of trade you're involved in. And then when the long setup is there, that's what you probably want to be more aggressive with. But the long setup's just not there right now. We need a flag to build out. We need a technical pullback. We need a higher low. We need something of that nature to give us the actual setup. And risk management is always number one, especially when you're doing things that are counter trend or counter momentum. What else, guys? Check out the YouTube from Joe, who's buying up here. Yeah, so today, who's buying here today? I don't know. I like that Goldman kind of gives us a daily update. I'll be able to see tomorrow morning some of who was buying today. I assumed I'll assume that we saw buying from hedge funds, long short funds, and long only funds today that propelled us higher. The corporate buybacks have been so important in this up move, but they're in their blackout window right now, so they're still buying, but they're buying significantly less. I think we're still getting a little bit of a bid from some systematic funds here, from trend following funds and vol control, but that's actually about to only get bigger. So they're going to be buying even bigger, no matter where the price is. Even if we're higher, they're probably going to be buying bigger. So that's who's buying. The way that markets work is there is a tremendous amount of forced buying and selling that occurs, whether that's because of a systematic strategy that doesn't care about things like fundamentals or technicals, or whether it's because it's a hedge fund who is underpositioned on a huge market rally and then is getting forced to buy in further into the market to try to play catch up. A lot of market movements occur just because the price of the price doesn't matter. It's the forced buying and selling that matters. Apex Joy asking me about INOD. I have no idea what this one is. INOD. InnoData Inc. up 4.5% on the day. I don't know this one. Chart looks great above 50, and it closed above 50. So I like it. I like it for a swing. I just, again, I'll repeat what I said this morning and probably on Friday morning as well. Someone was asking about Shopify, and I really like that Shopify through 115. Uh, I'm a top-down approach trader. So there are a lot of individual charts that you could point out to right now. For example, this INOD that I think look great. I'm not buying them when the index looks like this, unless there's news tomorrow morning. In which case, it becomes more of a news play than a more of a market correlated play. From Cyril, what is your opinion on potential squeeze higher and liquidating more shorts, some kind of a crash up? Yeah, I think it's very possible. I actually think that the IWM, even though the IWM was relatively weak today and is almost always relatively weak, I kind of think that the IWM is going to be what leads us higher in July. And it's going to be more of a continuation of a short squeeze type of move than anything. But we'll see. I think it's going to be short. I think that's going to be the comp basket that's rallying. I think it's going to be AI names that continue to rally as well. I think that that's where we'll be going. And eventually, a crash up would be a great signal to pay attention to if eventually we can get the market moving higher with the VIX moving higher. Now, the VIX was higher today with the market higher. It's just one day, and today was a little bit of a weird day with the end of month, end of quarter, and the JP Morgan collar and all that fun stuff. So I've kind of been tossing today out as a single day anomaly. But if you see continued VIX up, market up that lasts for a period of time of a few days or whatever, all of a sudden that actually becomes, I think, really notable that you could be closer to a top. But yeah, it's something we'll be looking at. Back over into the VTF. Yeah, the hedge funds are so underpositioned, Chris. They're so underpositioned on this move. They've been shorter than they should have been, not as long as they should have been, and now they're being forced to buy on both sides of that. And I get it, everybody's trying to be short from a more macroeconomic perspective on tariffs and the uncertainty that they bring. But it doesn't matter. Like I'll never forget the COVID period where the whole world was shutting down. I was short a Chinese travel agency and it was going up every day, but China was in full on lockdown. You can't explain that logically until you have an understanding about how market structure works. And then you realize that's what it is. And these markets just work in feedback cycles and you can't go down until the time is right. And that's where we're at. If anything, the fact that funds have been on the wrong side because of the macroeconomic view that tariffs are bad is what's going to further propel us higher. But, we'll see. I do think that this market needs a technical rest. Do tariffs even exist anymore, or is this conflict just his way of getting around them? I'm pretty sure that they still exist. They're not the numbers that were on his fun little spreadsheet that he brought out that day that wrecked the market. They're just sitting at like 10% for the whole world and 30% for China, which I still think even 10% tariffs are going to have a negative impact on the U.S. economy. But we spent a lot of time talking recently about how drawn out that is, and the most recent example of that is the Nike earnings report. Nike earnings report. This is one of the most important companies to show the tariff impact on the U.S. economy or potential tariff impact on the U.S. economy. They said that they are expecting tariffs to cause 3/4 of a basis point of a hit. A basis point. I keep saying that. 0.75%, 75 basis points of a hit on their margins, but they're not really expecting that to occur, and they're not really expecting to have to increase prices on the consumer. That's the most important thing until fall. So I keep looking at these earnings reports, particularly from retail names, and try to get a glimmer from what the CEO is saying on when prices are going to increase. Because remember, if the cost of your inputs are increasing, which is what tariffs will inherently do to any, especially retail company, if the cost of your inputs is increasing, you've got two choices for your corporate strategy, or you can implement a combination of those two. If your costs are increasing, you can 100% pass that cost on to the consumer, but that's going to reduce demand, reduce revenue, reduce sales for your product. Or you can eat the cost and have it negatively impact margins. If Nike makes, I'm just going to make up a number. I'm sure it's much larger than this, but I'm going to just make up a number. If Nike makes $10 per pair of sneakers that they sell, and all of a sudden there's a $5 tariff, they can choose to, again, increase the price of the product by $5, and people will demand less of it, or they can eat that $5, but that means that their margins are shrinking. They're not making that $5 anymore. One way or another, it hurts the company. And then the bigger read through, which is going to take. So think about this, right? Like if you're trying to think about timing, something I've thought a lot about, of the economic impact of tariffs on the U.S. economy. It's not an overnight thing, right? It starts by hurting retail. So again, then retail, Nike's gonna want to maintain its margins as best as it can. How is it going to maintain its margins? Well, it's probably going to eat it a little bit. It's going to pass through costs on a little bit, but it's also going to try to save in other places. One of the ways in which you can save in other places is through layoffs. Layoffs eventually trickle through the economy, because if you just got laid off, you're not going to be in a rush to buy that luxury good that you don't need but you want, that you would have bought if you had your job, but now you're not going to buy it, or go on that vacation. Or the big one, I think, for us as traders, as investors, is going to be losing the retail bid with unemployment ticking up. So, that's why I'm paying so much attention to these retail earnings reports, and the Nike one saying, "Hey, we don't really expect to see these impacts until the fall." I thought was very telling, because it's a whole next level of an impact before you could see that hurt Meta, right? Because Nike needs to be hurting in order to then reduce their advertising, and then you see additional layoffs trickle through the economy. Those people, take up less vacations. Delta starts getting hurt. They're also not buying the stock market in the same way anymore. So that can hurt the stock market, which then becomes a feedback cycle where the market's going down, so not making money there as well. So that I really think is the big question. So tariffs certainly exist. They're going to impact the economy. The timing of it is drawn out. So it also gives, the government some time to get these deals done before it overly negatively impacts the economy. But we'll see what deals they can get done and what those deals look like. But if we just settle at 10% with every country, I think it's still going to end up being a pretty big negative for the economy overall. And again, it's that thought process though, which is why hedge funds are underperforming so much. Stock market's at all-time highs, and anybody who's ever taken a couple introductory economics classes is scratching their head like, "Oh my God, what do I do? The stock market's at all-time highs," and everything I've ever learned says that the economy should be being negatively impacted, and I haven't participated in it, and then they're being forced in. So we'll see. BMNR. I don't know what's going on. Yeah, Lulu's been getting hit a little bit. A lot of these retail names, I was scrolling through a bunch of them recently, have not been doing so well. We have Constellation tomorrow, STZ. So yeah, that'll be an interesting one. Um, what do they own? I'm trying to remember exactly which liquors they own. I can't remember. They own some of the biggest ones, but I know yeah, they own some big beers. I think that they may own Modelo, and they've got some big liquors in their portfolio also. And I know like Canada, as an example, has not been buying U.S. liquor. From Ryan, can you talk a bit about your portfolio overall, most specifically your long versus short exposure, and when you'll be back to net long in terms of Q and SPY price at the ADMA? I've been long the month of June, and I'm sitting on open P&L in those longs, and have started to build into a teachable Q short the last few days to hedge and protect those profits. The trading skill I'm working to develop currently is hedging via index shorts, and I'm thinking through the game plan for this teachable Q short. It feels like the ADMA on the Qs is the right target given the market strength. Yeah, I do think it is. Um, that's a lot of that's where I that's kind of how I usually am. It's not how I'm positioned right now. Usually the way that I'm kind of approaching my portfolio approach, and I wish, but you know what they say about wishing. Wishing doesn't do anything for you. I wish I had been following my normal typical approach over the course of the last month and a half. It would have saved me a lot of money. I haven't been. But my normal typical approach, I'm almost always net long until we get into like the extreme upside. And then I start really building into the shorts, usually using like a T triple Q, something like that, as I'm liquidating those longs. And then at a certain point in the up move, I get net short. And then when we get the correction to equilibrium, I pretty much fully liquidate that short as I build back into the longs, which is pretty much exactly what you're talking about. So I think that if you've got those longs on and the market's been moving higher, and the way I do it is to like a build in, build out approach. When you get to $10 plus of extension, especially to the upside at the index level, beginning to build into a index level short, like a T triple Q short, as you are building out of some of those longs, is a great approach. And then you gauge your game plan on the T triple Q short to the ADMA, which will continue to rise. So you have to take that into account with the game plan that ADMA is going to continue to rise. Even if we get a price correction that starts tomorrow, the ADMA will still be higher tomorrow. So yeah, I mean that's I think a great way to do it. And then when the correction occurs through time or through price, you're then building out of the short and building back into the long. And it's been a great approach for me to do it that way for a long time. And I deviated from that approach this last month and a half because apparently, like a lot of fund managers, I got into my own head about how how bad tariffs are and how there's going to be consequences to this and everything else. And it's been to my detriment to move away from what has been my normal edge and my normal approach, and it's definitely resulted in some sizable losses and some overly aggressive shorts that I then pieced out of as the market on this breakout day for the market, and really the day before it. I took a lot of that short exposure off, and I've been trying to work back towards my kind of normal approach on the market. But now we're at a point where we're $10 extended, so I don't want to just further liquidate the hell out of my longs at this degree of upside. I mean, out of my shorts, I mean, out of this degree of upside extension. But I'm working on returning to some degree of normalcy, while at the same time keeping in mind keeping in the back of my head, I do still think I'm going to be right on the economic impact of these tariffs. But like I said earlier, it doesn't matter about being right. What matters is the timing, and the timing. What I need to occur for the real short trade to work for more than just a technical pullback to the ADMA is I need a catalyst, or the catalyst, which I think will be from an economic perspective, to line up with the positioning, with the structure, and that's what we just don't have. And honestly, there's a bull case to be made. The big beautiful bill is based on a lot of different analyst reports, is going to be increasing the deficit. Increasing the deficit is bullish for the stock market, at least in the short run. provided that our bonds don't implode. But we'll keep an eye on the bond situation. But I was reading a research report this morning, I think, that basically, I don't remember the exact numbers. I could pull it up, but the research report basically showed how the degree to which the big beautiful bill is going to be accretive towards GDP and increase GDP, because that's what deficit spending does, but that by, I think it was 2033, it's going to, the impact of the big beautiful bill on the deficit will, by that point, based on their model, begin to cause GDP weakening at an amount that will be greater than the increase in GDP from getting the bill passed now. But, again, this is 2025, right? So I'm giving you a piece of potential information for 2033. Who cares? It's so far away. So many things can happen by then. And it has zero impact. What could potentially happen in 2023 has zero impact on what's going to pay you and me in the market tomorrow. So it was, notable and interesting to read, but completely not actionable that it might have a negative impact overall in the long run, because it's going to have a positive impact in the short run. And, to what degree can that offset the negative impact from tariffs is a big question that I don't have the answer to, and it's to be seen. I appreciate the question, Ryan. I hope that helps. Back over to the YouTube. Not seeing anything else in there. Not seeing anything else in the VTF. So I will wrap it up. Have a great night, everybody. I will see you all tomorrow. And if you're in YouTube, you know what to do. Thumbs up. Tell your friends. Have a good night.